Good morning, everyone, and welcome to our discussion on the Autumn Statement, where our panel will answer your questions, highlight the key implications, and provide you some insight and guidance following Wednesday's announcements. I'm Jennifer Williamson, a partner at Creston Reeve, and I'll be chairing our session today. I'll just start by saying that we're delighted to have so many of you join us this morning. Now, for those of you who don't know Creston Reeves, we're here to help our clients with so much more than just accounting, business and wealth advice. We support them in achieving their ambitions so they can reach their brighter future, which is also why we host these webinars to help with any questions that you may have. So I'll start with a little bit of housekeeping for the webinar. This webinar is being recorded and a recording will be sent to you all later in the day. IT permitting, we'll be asking for a bit of interaction by taking some polls throughout the presentations so that we can share those results with you and generate some further discussion. There's also going to be a pop-up survey at the end of our session today, and we'd be really grateful if you could spare just a couple of minutes to provide us with some feedback. Now, we've already had some questions sent in before this morning, but please do continue to submit your questions throughout this session using the question functionality that's shown on screen so that we can answer these for you at the end of the presentations. So I'll leave that there just for a moment so you can familiarise yourself with that function. Great. So 2 days ago, Jeremy Hunt delivered his autumn statement. And before we get started, we want to hear your initial thoughts. So we're asking a few polls throughout the webinar, the first of which is about to appear on your screen now. How do you feel about the changes announced in the autumn statement? Were you very positive, neutral, negative, or very negative? So I'll leave that there to get a few responses in. Great, well, hopefully you've had a chance to have a think about that and answer. We'll show the results on screen now. Okay, so neutral is the most prominent response, and that's not surprising really, given that so much of it had been announced in advance, and maybe there weren't as many things as we might have expected. Okay, thank you everyone. Moving on. It's really a truism of parliamentary fiscal announcements that they are made in the context of the election cycle, and this was very much the case on Wednesday, with tax cuts announced pre-election to woo the wavering voters. Now, the background to the autumn statement is the UK has the tax levels at the highest since records began since 70 years ago. And the cause of this? Well, we have fiscal drag combined with wages rising ahead of inflation. And that's given even greater tax revenues than were expected, which was largely driven from the previous measures taken by the government to freeze the income tax bands. And that gave them plenty of wriggle room to make reductions now. And there was also the added pressure from the OBR after they reported the fastest fall in living standards since the 1950s. So Purdo was well and truly in the shredder, with much of what we heard on Wednesday pre-announced and speculated on well in advance. So the cut in national insurance, the making permanent of the full expenses on capital costs, and the simplification of the R&D tax relief scheme were all expected. And at the start of this year, Rishi Sunak made growing the economy one of his 5 pledges to the British people. Now, in normal times, that might have been an unambitious aim, but the economic situation has been far from normal. So Jeremy boasted that there were 110 measures to help the economy grow in the autumn statement, with policies aimed at encouraging worker participation, higher investment, and higher productivity. And the policies were really clearly aimed at a very wide demographic of voters, with something in there for the employed, the self-employed, pensioners and business. But will it be enough to swing the popularity polls in advance of next year's election? Or do we think they've got more up their sleeve for the spring budget? So let's take a look at some of the media headlines since Wednesday to give a flavour of the wider reaction to the measures that have been announced. So the Metro, happy NI year. So both the Sun and the Metro have begun celebrating the coming new year, with the national insurance cuts are due to kick in. The Financial Times, on the other hand, went with tax burden surges despite Hunt cuts. So the FT and the I took a very different view, focusing on the taxpayers facing a record high tax burden despite the tax cuts. The Independent went with biggest tax cuts since the 1980s. Who are they kidding? As one might expect, the Independent towed a more middle ground, seizing on the statement made by the Chancellor that these are the biggest tax cuts since the 1980s, and then reflecting on both the good and the bad coming out of the autumn statement. And for a bit of light-hearted relief, the Daily Star said, Stevie Wonder took me joyriding. Very light-hearted, avoiding the autumn statement entirely, leading on the story of the blind musician Stevie Wonder getting behind the wheel with pop duo The Eurythmics in the car. So a mixed response all in all, and I'll just take an opportunity now to introduce our speakers who are going to be giving their analysis of the announcements from the autumn statement before we move on to the discussion. So to introduce our panel of experts, we have Daniel Grange, who is our head of tax. We have Sam Jones, who's one of our corporate tax partners, and Terry Burgum, a chartered financial planner. So, were there any rabbits out of the hat from Wednesday, or important fiscal details that were glossed over in the Chancellor's speech? Well, let's find out more from our presenters. So first, I'm going to hand you over to Dan Grange, who will be summarising the top implications for individuals. Over to you, Dan.
Thank you, Jennifer, and good morning, everybody. Despite the speculation that Jennifer's talked about in the press about potential changes to inheritance tax and income tax, there was really only one change in the autumn statement that affects individuals, and that was the change to national insurance. As you may know, there are different classes of national insurance that are payable depending on whether an individual is employed or self-employed. And employees are currently subject to Class 1 national insurance, and the main rate is currently 12%, which applies to income between £12,570 and £50,270. On Wednesday, the Chancellor announced that this will reduce to 10%, and rather unusually, this change will apply mid-year from the 6th of January 2024. This 2 percentage point reduction will save an employee up to approximately £750 per year if they earn over that £50,000 level. The rate of Class 1 national insurance that's payable on income over that £50,000 level remains at 2%. And whilst the rate of Class 1 national insurance for employees is reduced, the Class 1 that's payable by employers has not changed and remains at 13.8%, as it has been for some time now. For the self-employed, and that includes members of trading partnerships, they have to pay both Class 2 national insurance, which is a fixed rate of £3.45 per week, and Class 4, which is calculated as a percentage of profits. The main rate of Class 4 national insurance is 9%, and that will reduce to 8%. But that change isn't happening mid-year, like the employees' change. That's coming in from the 6th of April 2024. And again, that main rate of national insurance is charged on profits between the £12,500 figure and just over £50,000. And the top rate of Class 4 national insurance remains unchanged at 2%. So on Wednesday, the Chancellor also announced that the Class 2, so the fixed weekly charge, is going to be abolished from the 6th of April 2024. If you're self-employed and have profits of more than £6,725, you will qualify for credits towards your state pension and other benefits, even if you don't have any national insurance liability. If your income is below that £6,725 level, and you want a state pension credit for a year, you will need to pay voluntary national insurance contributions, which are currently about £900 a year. And as I say, that was all that was announced on Wednesday that affects individuals. But I thought it was worth taking this opportunity to remind you of some of the changes that were announced a while ago, where there were some planning opportunities, or where the full effects of those announcements made some time ago have not yet been felt. So back in March, which seems a very long time ago, the Chancellor announced significant changes to the rules applying to pensions. And those changes were both to the annual allowance and the lifetime allowance. The lifetime allowance is the maximum value of your pension fund that you can have before you pay something called a lifetime allowance charge, which happens on a benefits crystallisation event, which is effectively starting to take benefits from your pension scheme, turning 75 or death. And the lifetime allowance charge was abolished with effect from the 6th of April 2023, but the lifetime allowance itself still remains in legislation. And draft legislation was published earlier this week to abolish that lifetime allowance itself with effect from the 6th of April 2024. The other change made earlier in the year was to the annual allowance, which is the amount that can be contributed to your pension fund each year without incurring a tax charge. The standard annual allowance for the current tax year is £60,000, whereas in previous years it was £40,000. And this allowance is reduced for high earners, and the way that reduction is calculated also changed from the 6th of April. The change means that the taper, the reduction in that annual allowance, only applies to those earning more than £260,000 rather than the previous £240,000. And the minimum annual allowance that you can have in any one year is now £10,000, whereas under the old rules it was £4,000. And I think it's helpful to show the impact of this by way of an example. So in this example, we have an individual who has income of £300,000 both last tax year, so 22-23, and this current tax year when the new rules apply. So last year the standard allowance was £40,000, and this is reduced by £30,000, that taper, because the individual's income was more than £240,000. So last tax year, an individual with income of £300,000 had an annual allowance of £10,000. For the same individual for this current tax year, the starting allowance is £60,000, and the restriction reduces to £20,000. So that means they can contribute in the current tax year up to £40,000 without incurring a tax charge. So they can contribute an additional £30,000 to their pension fund, and with the tax relief that they'll get on that to get an extra £30,000 into their pension fund, it will cost them £16,500 if they make a personal contribution. I appreciate that this example is of a high earner and may not be relevant to everyone, but I think it highlights the changes, and for those people in that bracket, the opportunities that are there. So there's therefore scope to make higher pension contributions in this tax year than there have been in the past. And I think it's worth remembering that if you've got unused allowances from the previous 3 tax years, you can use those as well. So I'd recommend that you review your pension contributions over the last 4 years and see what unused allowances you have available. Not everyone's a fan of pensions, but I think it's worth remembering that as well as the tax relief on the contributions that you can get into the pension, whether that's as an individual or as company contributions, those funds grow income and capital gains tax free, and the value generally isn't subject to inheritance tax on your death. So they're incredibly tax efficient wrappers for holding investments. We know there's going to be an election before the end of the 24-25 tax year, and Labour have said that they will reverse the annual allowance changes, and it's possible they will also change the lifetime allowance rules or reintroduce them. If they do reverse these changes, there could be a limited window for high earners to make higher pension contributions and so take advantage of those current rules. So from a tax perspective, I'd recommend that you review what allowances you have brought forward and consider whether making additional pension contributions before the end of this tax year, so the 5th of April 2024, when we have certainty about the rules, would be sensible. Because of the way the brought forward allowances work. If you have any unused allowances from the 2020-2021 tax year, these will lapse if you don't use them by the 5th of April 2024. Another change that was announced a while ago but was really now coming into sharp focus is the change to the basis period rules. And these are the rules that determine which profits of an unincorporated business, so sole traders and partnerships, are taxed in which year. Under the current rules, we operate on a current year basis, which means that the profits of an accounting period ending in the tax year are taxable. So, for example, if we have a partnership with a 30th of June year end, the profits for the year ended 30th of June 2023 would be taxed in the current 23-24 tax year. And the effect of these rules is that the payment of tax on profits can be deferred significantly. When a new trade starts or an individual becomes a partner in a partnership, some of their profits are taxed twice, and this creates something called overlap profits. And these overlap profits are released when the trade ceases or the partner retires from the partnerships. So there are new rules coming into force that change this basis of taxation. And instead of being taxed on a current year basis, profits will be taxed on a tax year basis. And this means that profits generated in the period 6th of April to 5th of April will be taxed in the tax year. So if you already have a 31st of March or 5th of April year end, these changes will not affect you. But if you have a different year end, then they could well have an impact. So the current 23-24 tax year is the year of transition, with both the historic current year basis and the new tax year basis profits being taxed, but with relief for those overlap profits that were generated when you started being self-employed. HMRC recognised that this transitional adjustment could be very significant, and so it's possible to spread the additional taxable profit over a 5-year period. For those of you who are affected, the transitional rules mean that more profit is likely to be taxed in the current 23-24 tax year, and may in turn lead to significantly higher tax payments being needed by the 31st of January 2025. And this is a combination of both the balancing payment for the current tax year and the first payment on account for next year. So if you're a sole trader or a partner in a partnership and you do not have a 31st of March or 5th of April year end, and you haven't looked at this yet, I would really recommend that you check that you know what your overlap profits are. If you can't find these, and they may have been generated a number of years ago, you can ask HMRC to provide those details. You should understand the impact on you and plan for the future tax cash flows that will start in January 2025. And consider the year end of your business. If you don't have a 31st of March or 5th of April year end, there will be more administration needed and time apportionment of results to calculate your taxable profits. Finally, from me, there's one small change over the past couple of years to remind you about, and that's to do with the capital gains tax annual exemption. So that's the level of capital gains that you can realise tax-free. So last tax year, it was £12,300. This year, that's more than halved to £6,000. And then for next tax year, it's going to halve again to £3,000 a year. So this particularly affects clients with investment portfolios who realise gains, capital gains each year up to the tax-free limit. So that's just something else to look out for and be mindful of when you're thinking about selling those investments. I'll now hand back to Jennifer.
Great, thanks very much, Dan. I think we find that national insurance is one of those magic taxes for a chancellor, don't we? When it's going up, they say it's not a tax, and when it's going down, it's a tax cut. But next, I'm going to summarise. I'm going to pass you over to Sam Jones, who's going to summarise the top implications for business. Over to you, Sam.
Thank you, Jen. Good morning, everyone. The headlines prior to this week's autumn statement were all about cutting taxes. Businesses may have been hoping for a reduction in the 25% corporate tax rate, however, there were no changes announced there. A quick reminder of where we are with CT rates. Since April 2023, the corporation tax rate is 25% for companies with profits above £250,000, with a small company rate of 19% for those with profits under 50,000. There is marginal relief for companies between those two limits. Don't forget that these limits are divided by the number of group or associated companies. The biggest change for companies in the Chancellor's speech related to the R&D reform. Given there was a consultation in the spring about merging the two schemes, this announcement came as no surprise. I'm going to cover that in a bit more detail later. The Chancellor did announce full expensing relief is to be made permanent. At the time, the relief was introduced as a temporary measure until March 2026, with the Chancellor committing to making the relief permanent as soon as finances allowed. This Chancellor has made good on his promise and the relief will remain permanently. Broadly, full expense relief allows companies to deduct the cost of new plant and machinery against taxable profits in the year that the expenditure is incurred. There is also a 50% relief for expenditure that falls within the special rate pool. Given full expense relief is here to stay, there were no changes to the annual investment allowance, which remains at £1 million. With these two reliefs, majority of businesses will see full relief for all of their eligible capital expenditure in the year of spend. The other change announced impacting businesses is the 9% increase in the national living wage. Businesses will see an increase in their employee costs and need to make sure they are compliant with the new rates, especially those with any salary sacrifice arrangements. So moving on to R&D. The Autumn Statement announced that a merged R&D scheme is to be implemented for accounting periods beginning on or after 1 April 2024. As mentioned, this announcement came as no surprise and is meant to be a simplification of the R&D schemes. I'm sceptical. The merged scheme will be modelled on the current RDEC scheme, which is mainly used by large companies. The RDEC scheme gives an above-the-line credit at 20% of the qualifying R&D spend. However, this credit is ultimately taxed, so the true value is net of the corporation tax rate. The effective value of the R&D tax credits under this merged scheme will be around 15%. There have been so many changes to R&D over the past 18 months, which have been a big blow for the R&D market. R&D tax credits provides vital support for innovative SMEs, and the reduction in the R&D rates and restrictions on the qualifying spend is squeezing the value of the relief. Prior to the 2023 changes, SMEs could receive up to a third of their R&D spend via R&D tax credits. From April 2023, this was slashed to just 18.6%. Now, under the merged scheme, this will drop further to 15%. Due to industry lobbying, HMRC has U-turned slightly, and if you are an R&D intensive company, then the repayable tax credit remains at 14.5%, giving a net benefit of 26.97%. An R&D intensive company is one whose R&D expenditure is 40% of their total expenditure. One positive change from the Autumn Statement is that the 40% threshold will reduce to 30% from April 2024, and loss-making R&D intensive SMEs can remain in the SME scheme. I'm not sure this is simplification. I've been struggling to follow through the guidance, so please do get in touch and we can work through changes with you. The previous announcement on restricting overseas expenditure is still to be implemented, with the aim to encourage UK-centric spend. There has been clarification on subcontracting arrangements, with the decision makers being able to make the R&D claim. We're still waiting for the legislation on this topic. So moving on, is there anything else you should be mindful of? We all know interest rates have rocketed in the past 12 months, and this is now being felt by businesses as they refinance. There are several things I think you should bear in mind. HMRC levy late payment interest, which is currently at 7.75% on any late tax payments. That's your normal payment or any quarterly instalments. Generally, companies need to pay their CT liability within 9 months and 1 day after the period end. With the increased CT rates coming through, any late payment interest could come as another blow. This has caught out several of my clients who should pay their tax by quarterly instalments, but never saw the HMRC late payment interest as a punitive cost, and they now owe a few thousand late payment interest. Another area to keep in mind is that the corporate interest restriction will impact more companies due to their increased interest costs. The UK operates legislation to limit corporation tax deduction for interest paid, and where companies or groups have net interest expense in excess of 2 million, there could be restrictions on the tax deductibility. There have been minor changes in legislation for some key reliefs. Currently, if you grant EMI options to your employees, you must notify HMRC within 92 days. From April 2024, this admin requirement falls away, which will be a welcome relief. The grant of EMI options will be notified as part of the EMI annual return process. The sunset clauses on the EIS and Seed EIS schemes were due in April 2025. These have been extended to 2035. These reliefs are key for early stage companies looking for external investment and offer great tax incentives for investors. So that's all from me. So I'll hand back to Jen.
Thank you very much, Sam. I think we heard that increase in the national living wage you mentioned is expected to benefit nearly 3 million workers. However, I really suspect there's going to be some disappointment from the businesses who are going to suffer that increased wage bill, that there's been no compensation for employers, say through a reduction in employers' national insurance. Thank you, Sam. So we're now going to ask our second poll question. So on screen in a moment, you should see that. Business owners, so those of you who have joined us today who are business owners, what is likely to be your main priority over the next 3 to 6 months? Is it going to be growing your business, sustaining your business, business survival, selling or exit, or something else, other? Okay, I shall leave that there for a moment while we get some responses in. Great, let's have a look at the results. Okay, mainly sustaining and growing. So ambitions seem to be along the lines of what the Chancellor's hoping and the Prime Minister for the economy. So keeping things stable and with an appetite towards growth. That's really helpful. Thank you everyone for your responses. So just a quick reminder that if you want to ask any questions of our panelists, you can do so through the question box that I showed you earlier on. Please do keep them coming. So before we move on to our panel discussion and questions from the audience, I would like to briefly touch on 2 non-tax announcements that came out that affect business, because the Chancellor made many references to being a budget to back business, encouraging investment and growth. So 2 headline measures that did actually address some of those real-time challenges faced by business were that firstly, there's going to be an extension of the 75% discount for retail, hospitality and leisure on business rates for a further year. So that could really ease the cash flow burden for those sectors struggling the most as the cost of living crisis continues. And secondly, for those businesses struggling with recruitment, the government also announced funding of 50 million over the next 2 years in association with Make UK and others to pilot ways to increase the number of apprentices in many growth sectors across the country, which I'm sure will be welcomed by many business owners, both in the short and long term. Okay. So now moving on to our Q&A session. We have had some questions in. Please do keep them coming. Please submit throughout this session. If we're not able to answer all of your questions today, then we will be in touch after the webinar directly to answer your questions. Right, let's get cracking. If I could welcome back all of our panelists. Lovely, thank you very much. So Dan, I'm going to start with a question that's probably directed towards you. We've had a question in from Peter, who has asked, what's happening with inheritance tax now?
Thanks, Jen, and thank you, Peter, for your question. I did think we might get some questions about inheritance tax, given the speculation in the press ahead of the autumn statement. And preempting that, I have done a bit of research and a bit of just checking some details. So the simple answer is that no changes were announced earlier this week. So the rate of inheritance tax remains at 40%, and the tax-free nil rate band remains at £325,000. and that's been the threshold since April 2009, so 14 years with no increase. And Jennifer earlier mentioned about fiscal drag, and this inheritance tax really is one of those taxes where fiscal drag has had a big impact. So I'm sitting in our Horsham office today in West Sussex, and according to the Nationwide House Price Index, a house in this area that was worth £325,000 in April 2009 would now be worth approximately £620,000. So an increase of over 90% in a period where we've had no increase in the tax-free inheritance tax threshold. So that will clearly mean that more estates are being caught within the inheritance tax net. As well as the £325,000, there's also potentially the residence nil rate band that gives an additional tax-free sum of £175,000 per person to offset against the value of your house. But as always, there are lots of conditions that go with that. And one of those is that the value of your estate is less than £2 million. So if your estate's worth more than 2 million, then that starts to taper away. And those tax-free allowances, both the nil rate band and the residence allowance, can be transferred between spouses on death. According to HMRC statistics, for the latest year they provided data, the total number of estates that paid inheritance tax was about 27,000, and the average effective rate of tax paid by those estates was about 13%. So I think that's quite helpful just to give a bit of context about how big an impact this has on people. I think people are more worried about it than the real impact on estates. So given there were no changes announced and given an impending election, what should you be thinking about? Before we think about tax, I think there are a couple of key questions that you need to be thinking about. So primarily, what income and capital do you need to live comfortably? If you do give assets away to try and save inheritance tax, you generally do that and then can't have access to the income or capital. So it's pretty much a one-way street. So think about what you need. And then secondly, who do you want to receive your assets, and are you happy for them to have unfettered access and control to them, or actually do you think there need to be some control measures around those assets? And then once we understand your personal needs and wishes, we can look at the options that are available. So that might include gifts into trust, outright gifts. There's an inheritance tax exemption that I think is often forgotten, which is gifts out of surplus income, and they're completely exempt from inheritance tax without a 7-year clock. Or some people may decide that insurance is appropriate to help fund the tax, so assets don't need to be sold, particularly if there are young children around. One of the things in the press was about the potential for inheritance tax to be cut to 20% by the Conservatives. Unfortunately, we can't generally control when we die and whether we would therefore benefit from that lower rate of tax. It may have some impact on lifetime planning if you're going to put significant value into trust, and that would involve incurring a lifetime inheritance tax charge. But given the way the rules currently work, it's likely that if you died within 7 years, there would be a clawback, and it would go back up to 40% if that was the rule or the rate in force at the time that you die. So I think the really important thing here is that inheritance tax planning is really personal and needs to be tailored to your circumstances and what you want to achieve. It's really difficult, and we would generally not recommend that you plan on the basis of potential changes in the future, because we've seen lots of times that those don't come through, or there's detail in there that means it doesn't work. My final point on this would be it's really important to ensure that you've got a will in place and that it's up to date, reflecting your current wishes. Jen, back to you.
Thank you very much, Dan. So I think what we hear is no changes from the autumn statement, but if you've got planning to do, crack on with it and don't wait and see what's coming out in the future, because who knows what that might look like. Sam, we've got a question that's come in that I'll direct to you. It's come from Karen. How can a small business influence our corporation tax rate?
So small businesses, I'm going to say, are those below the 250k profit threshold, and therefore they're trying to keep their profits below the 25% tax rate. So they could, as Dan's mentioned during his talk about pensions, if the company makes pension contributions on behalf of directors or shareholders, then those pension contributions are actually tax deductible. So that's one way of reducing your profits that you might have had. Another way is the full expense relief, the annual investment allowance. So if you need to buy some capital expenditure, you can be pretty confident that you can get full relief in the year of spend. There's not loads you can do to manipulate it too much, because obviously under accounting rules, you have to bring your profits in on an accruals basis. So there's not loads you can do, but there are those easy tricks of making sure, consider what your pensions might be and make sure those payments are made pre-year end. And also, if you need capital expenditure, then you've got the full relief available in year one.
Great, thank you, Sam. Terry, I'm going to come to you next. It's about the abolition of the lifetime allowance. So what change does the abolition of the lifetime allowance have on death benefits paid from pensions where the member dies pre-age 75?
Thanks, Jennifer. So as Dan mentioned earlier on, the lifetime allowance abolishment was announced in the last spring statement, and that meant that the excess lifetime allowance tax charge was immediately reduced to 0%. So from 2024, we have an introduction of a new allowance called the lump sum death benefit allowance, which governs the taxation of lump sums paid from pensions during your lifetime, and also lump sums paid out on death. So there's not a huge amount of actual effective change. So effectively, again, you have a death benefit allowance, which is set the current lifetime allowance rate of £1,073,000. And that could be higher if you continue to hold some form of lifetime allowance protection, such as fixed protection or individual protection. The amount of benefits, therefore, that are paid out on your death is tested against your remaining death benefit allowance, which will be reduced by any tax lump sum you take during the course of your lifetime. Benefits which fall within that available allowance are paid out tax-free. Any benefits paid out as a lump sum above that allowance will be taxable as income tax on the beneficiary's highest marginal rate. However, benefits can be also transferred to a sort of a beneficiary's drawdown, where there will be no immediate taxation, and if you've died before age 75, the beneficiary can draw those benefits out free of income tax. So generally, people will possibly take any death benefits within the lump sum allowance within the death benefit allowance tax-free, and any excess will probably be transferred to a beneficiary's drawdown, where they can then draw it out free of income tax at a later date. I hope that's fine.
Great. Thank you very much, Terry. Quite a lot going on there. Sam, I've probably got a couple of questions that have come in that I'll direct to you now. We had one from Darren. He's asking, this is to Dan, sorry. We had one from Darren about employees' national insurance and whether there's going to be a hybrid rate for directors, as directors normally have a cumulative employee NI.
Yeah, that's absolutely right, Darren. Normally it's directors' national insurance is calculated on an annualised basis. Helpfully, there's no guidance from the revenue yet on what's going to happen for directors. My expectation would be, as you say, that we would have a hybrid rate, and we did have that in previous years where there were changes in national insurance mid-year. So my expectation is that we will have a hybrid rate of somewhere between 10 and 12% that will apply to directors, but we haven't got that guidance from the revenue yet. It will be interesting to see whether the payroll software providers can make all the changes necessary by the time we get to payroll runs in January.
Great, thank you, Dan. So wait and see, but we expect a hybrid rate. Sam, I've got a couple of questions now that are sort of directed around capital allowances, and that's, the reliefs you get on qualifying plant and machinery that businesses buy. So the first one comes in from Richard. He asks, can you please clarify how this measure will save businesses any tax over typical 5-year write-down period of an asset? By writing off 100% in year 1, don't you end up paying more corporation tax in years 2, 3, 4 and 5? So is it just a deferral, albeit a cash flow benefit?
Yeah, of course. Yeah, Richard, I think you've pretty much hit it nail on the head. So capital allowances are these expense relief and annual investment allowance is allowing you to take deduction for your expenditure in year 1. It is just a cash flow timing, because before you would have put them to your general pool, for example, and you would have got that relief written down each year by 18%. But actually, when you used to put assets into your pool, it used to take nearly 20 years to get the full relief, whereas these reliefs are actually allowing you to get relief in year 1. Obviously, depreciation that you have in your accounts is disallowable, so capital allowances and these reliefs are HMRC's version of depreciation. It takes the ambiguity away from that. So yeah, it is a cash flow timing. Most people's assets, you continue to use them until they're potentially worth nothing or just scrap. So therefore, this is a way of mechanism to be able to get that relief. I think I can see another question on there. I'm just going to take that one, Jen, which is from George, which was around about what relief is there for capital expenditure outside of year 1. So obviously, if you don't have to use these reliefs, they're not automatic, you'd have to claim them. So if for whatever reason you didn't want to claim capital allowances, perhaps you wanted to defer them, you can hold them, but you wouldn't be able to get that full relief again. So annual investment and full expenses, you can only claim in the year of spend. Sometimes people choose to disclaim capital allowances in their computations because they know they're going to have larger profits coming up and they're in a growth stage, and therefore they're making big losses in the beginning. Therefore, they might choose to defer them, but then you're only going to be getting them at the standard writing down allowances, which is 8% or 6%, 18% or 6%. So it is a choice that you've got, and there is some capital allowance planning we can do with you around that if you've got significant spend.
Great, thank you, Sam.
Can I just add something there on capital allowances? So Sam's talked about the annual investment allowance, which is £1 million, and then the full expensing of capital expenditure. The annual investment allowance for £1 million is available to all businesses, so whether that's a sole trader, a partnership, or a company. The full expensing of capital expenditure over and above that is only available to companies. So if you're a partnership and you're incurring significant capital expenditure, it's only on that first £1 million. And I think the government's own statistics showed that it was north of 95% of businesses that spend less than that £1 million on equipment a year. But it's just something to look out for if you are an unincorporated business and you've got significant capital expenditure that you're planning to incur.
Great, thank you, Sam, and thank you, Dan. Terry, I'm going to turn to you next. It's a question about national insurance, but I think it's probably linked to some pension elements. So why would someone choose to make voluntary national insurance contributions? I think that's probably class 3 national insurance contributions.
Yeah, okay, well, obviously class 3 is about the only one that hasn't been challenged in this statement. So basically, to get a full state pension at your state pension age, which for most people now will be 67, you have to have at least 10 years national insurance contribution years and 35 to get the full state pension, although that you might need more if you've previously been contracted out through some form of occupational pension contracted out SERPs or the state second pension in previous years. So by paying an additional class 3 contribution, which costs just over £900 a year, as Dan mentioned earlier, you can gain 1/35 of the current state pension, which is effectively about £302 a year. And of course, you get that every year for the rest of your life, plus all of the index-linked increases. So for an average male sort of retiring at 67 and living to 86, for paying £300 extra contribution, you might benefit from over 5,700 plus all of the increases over your lifetime. So it really is a very valuable way of increasing your pension provision at a very low cost. The key thing is that it's a bit of a cliff edge at state pension age, so you must make these contributions or any back payments for missed contributions before you hit state pension age, because you won't get the opportunity to do it afterwards. So my advice would be to check your state pension forecast as early as you can, and then work out how you want to make sure that you are going to get the full state pension.
Great, thanks very much, Terry. And I think that probably helps answer a question that came in from Sue as well, who asked, may I clarify, self-employed with low profits will now need to pay approximately £900 voluntary contributions per year to preserve entitlement to state pension, instead of approximately 175 re class 2. Any comments from the panellists on Sue's point?
I believe, and I need to check the detail, but I believe that so you can still pay voluntary class 2 if you're on the lower earnings. Don't know if someone can confirm that.
Like you, Terry, I think that's right. There was historically, or has always been, a low profit threshold for class 2 national insurance that you didn't need to pay it, and that was at this 6,700 level. But I think you're right that if you were self-employed, you could opt into class 2 to give yourself a state pension credit. Again, I've had a quick look because I saw the question coming in. I can't see any guidance from the revenue on whether you will be able. I think the only option will be class 3 now, because class 2 won't exist as an option to make voluntary contributions.
Okay, thank you, Dan. Thank you, Terry. Sam, I'm going to come to you with one around the corporate interest restriction that you mentioned. So the question is, with interest rates increasing, I'm concerned about the corporate interest restriction affecting my company. What should I be doing?
If you think you're getting near to the £2 million, then definitely come and talk to us, because there are some early protection claims you can put in. So even if you're below the 2 million now, you can put in a protective claim, which is kind of like building up your piggy bank, your allowance that's available. And you can do that in any of your open tax returns, which would mean when you do breach that £2 million threshold, you might be able to get a deduction more than the 2 million. The restriction is based on net group interest costs. So actually you would look at what is the net external debt that you're suffering in the UK, and therefore that is what the calculation is based off. And also, if you've got significant profits, then you might actually get a bigger allowance than the 2 million, because there is an EBITDA calculation within that. So reach out, we're happy to look at that, and it's always good to know what restriction you might have in the future.
Okay, thank you very much, Sam. Terry, I'm going to move to you. You may feel like you've covered this already, but it's coming in again. So let's answer the question. What changes to tax-free cash and entitlements does the abolition of the lifetime allowance have?
Yeah, so under the new lump sum and death benefit allowance, you'll have a tax-free lump sum allowance to take benefits from, which basically is set at £268,275. So it's effectively 25% of the current lifetime allowance. But again, if you have a form of individual or fixed protection carried over, then you will have a higher tax-free cash allowance. So effectively, what will happen is when you crystallise pension benefits, 25% of those can be taken as tax-free cash still, up to your available allowance. And if you've previously taken tax-free cash, then your allowance will be reduced by the previous monetary amounts that you've taken to work out what you can, what's left to be able to take as tax-free cash from uncrystallised pension benefits. So nothing really, no real change to the amount you can take, just a slightly different way of looking at it.
Okay, thank you very much. We did have an interesting question in that I don't think we know the answer to, and it's not tax related, but I'll just read it out in case there's any commentary. So a question from Richard was, has the Treasury or the OBR issued any forecast for average earnings inflation, taking account of the 9.8% rise in national living wage and similar increases for all employees on most salary levels above the national living wage? So I think it's a really interesting point that Richard makes there. I don't believe we've seen any statements from the Treasury or the OBR bringing those into their forecasts, but you're right, Richard, it's inevitably going to have quite a significant impact. You know, I think I said that there was millions of people affected by this national living wage change, and it's a big increase, and we've seen changes over recent years. So yes, I think we need to look out for that and see how that affects the figures. I'm sure that they'll be talking around that a lot coming up to the future announcements. Any other comments from the panelists on that? No. Okay, I'm just going to check if there's some more questions. Bear with me. Nothing new in at the moment, so I'm going to just move to a question that I'm going to ask to everyone. So what are your predictions for the spring budget, everyone? I'll start with you, Dan.
Thank you. I'm always really bad at budget predictions. I always leave that to one of my tax partners who's very good at coming up with these things. Clearly, we're going into an election cycle, and so I would expect that the Chancellor has kept his powder dry in some way, and that we will expect some easing in personal tax in particular, whether that's an announcement around releasing thresholds that have been frozen, or whether it's a headline reduction in income tax. I think that's where they will get the biggest impact, something that's very broad reaching. As I said earlier, there was lots of speculation around inheritance tax and potentially cutting that from 40% to 20%, but it's only 27,000, 30,000 estates a year that are paying that. So it's a headline grabber, but it doesn't really affect the cash that's in people's pockets. So I think changes around income tax and releasing some of the fiscal drag that we've seen, and I wouldn't be surprised if we saw a reduction in the headline rate of corporation tax. I think the Chancellor made it very clear on Wednesday that we're still one of the lowest in the G7 as our headline rate, but it is significantly higher than we've seen in the UK over the past 10-15 years. So going from 19 to 25% was obviously a very, very big increase earlier this year. So those would be my predictions, but I suspect that some rabbits will come out of the hat just as we're entering into an election cycle.
Yeah, I think I'd concur with that, Dan. I think probably the Labour party is trying to sort of rub out any distinction or any line between the parties on some of these changes that were announced on Wednesday, because they're broadly in agreement with them. So actually the Conservatives probably feel like they need to hold something out for spring to create that differential in the lead up to an election. So Sam, you heard Dan say he thinks there could be an announcement on corporation tax. What are your views?
Yeah, I think the headline corporation tax rate is a bit of an easy win if there's want to get some voters. Also, we're seeing things like all the way across the OECD trying to get a minimum level of tax, which is due to be about 15%. So, you know, it's quite topical what headline rates of corporation tax are. So I wouldn't be surprised if that drops. Whether it gets back down towards 20%, not sure. It might just be 1 or 2%, but it's still something that's worth considering. I think the other thing that everyone always asks me before a budget is, are we going to see a change in the CGT rates, for example? I've had, as usual, a few transactions that need to complete before budget day, autumn statement day, more budget day than anything else. So therefore, you know, it is always rumoured that they might change the CGT rates, which are 20% or 10%, 28% if you've got property. You know, that's quite low, and they've always talked about whether or not that might come in line with the same levels as income tax, which would be, well, it change a lot of our tax planning and decision making by entrepreneurial businesses.
I think something else we often hear about, Sam, is this speculation that at some point they'll bring national insurance in on dividends. I guess that's more a personal, well, it's a combination of the two, but do you get any views on that, Dan or Sam, whether we, you know, now they've reduced the national insurance rate, might they do something on dividends, or you think not?
My personal view on that is probably not, because given the increase in the corporate tax rate for larger companies, the reduction in the employees' national insurance, actually it's generally now more tax efficient to take salary rather than dividends. So particularly for owner managers, if they did impose dividends on national insurance on dividends, nobody would take dividends out of their own company. So I think if you look at the combined corporate and personal tax rates, it's pretty close, and the balance has slightly gone in favour of salaries now. So my personal view is no, but as I say, I'm not very good at these budget predictions.
Yeah, they'd really have to do something on the tax rate on dividends, wouldn't they, to make that possible? Okay, thank you. And Terry, anything you think might come out next spring on pensions?
No, I wouldn't like to make any predictions, that's for sure. But I mean, one of the perennial discussions is whether or not tax-free cash will ever be either reduced or withdrawn completely. Again, we haven't seen any changes to that, but I think with the increase in personal allowances and obviously the thresholds for tapering, which will encourage people to put more money into pensions, what we've got to remember, of course, is that these new allowances for the amount of tax-free cash you can take aren't set to increase. So effectively, pensions are being pulled into this fiscal drag of stealth taxes as well as we go forward. So yeah, that's an interesting point.
Great, thanks very much. So we've had no more questions come in from the audience, so I'm just going to take us now to our final poll. So shortly on screen you should see that come up. When do you think, the audience, when do you think the next general election will be held? Do you think it could be as soon as this winter, or spring next year, summer next year, autumn, or the latest possible date we know it could happen, which is winter next year or early into 25? I'll just leave that there for a moment to see what the audience view is. Great, let's have a look at those results. Autumn next year is the majority of people. Okay, so no one thinks it's going to be early 24, but perhaps autumn 24. So maybe slightly earlier than the latest they could call it. But yeah, mostly still thinking towards the end of next year. So we definitely should expect, if that prediction comes true, a spring budget from the Conservatives. So let's see what that holds. So that just leads me to say thank you to everyone who joined us today. Thank you to our panelists for your presentations and for your really insightful answers to those discussion points. If there's anyone watching this webinar today who has any additional questions or any matters that you would like to discuss further with the team, please just leave a brief description of that when you get the pop-up survey at the end of the webinar, and we will be in touch. Please also do complete that very short survey at the end, so we can really work on continuing to improve these webinars and events for you. We really do value that feedback you give us. So that leads me to say, whether you're already a client working with us or not, if anything has come out of today that you'd like to discuss further, please get in touch. We'd be really delighted to hear from you. So thank you very much, everyone, for joining us, and I hope have a good rest of your day. Take care.